Yeah, if you kind of think about breaking down what that 30-year rate represents in terms of risk or, I guess return to whoever is investing or lending that money, right? I mean, we talk a lot about how mortgages follow treasuries pretty closely, but they don't always follow them exactly. So you kind of start with shamelessly steal a post I saw on LinkedIn, I think originally from Freddie Mac a few years ago, kind of like building up a mortgage rate. So you start with, call it a risk-free rate, right? The risk-free rate, you can assume it's kind of like the 10-year or, some risk-free rate, even, the Fed funds rate at some level, right? And then you start from there and you build it up and you say, all right, what is a 30-year rate to a borrower represent? Well, the borrower isn't going to, not every borrower is going to have that mortgage for 30 years, right? They're going to move, they're going to refinance. And so you're estimating what is the return you need for a loan that lasts on average 5 to 7 years, right? So you kind of blend in some sort of return of what you would expect to have for 5 to 7 years there.